Well, good morning, everyone. Welcome to our market update webinar for Q2 2025. Excuse me. My name is Cole Pearson. I have the privilege of serving as President of Investment Solutions here at OneAscent, and delighted to serve as your moderator for our call today, joined by Nathan Willis and Pete Klingelhofer from our team. Before we get started, as we have done for the last several years, I'd like to open us in a quick word of prayer as we start our time today. Heavenly Father, God, you tell us in your word in Proverbs 3, 5, and 6 to trust in you with all our heart, to not lean on our own understanding, and to in all our ways acknowledge you, and that you will make our paths straight. Lord, these are uncertain times. We feel that in the markets. We feel that in just our lives. Lord, I pray that for each family, man, woman represented on this call, that you help us to trust in you, to lean on your understanding, not our own. Lord, we do thank you for this time this morning that we can talk about what's going on in the markets and money and repurpose that and reposition that as a tool for stewardship to bring you honor and glory. We pray that you be with us now, and we ask this in your son's name. Amen. Well, again, welcome to our call this morning. Today's a big day. It's tax day. We're in the middle of Holy Week, getting ready for Easter. So we thank you for taking a few minutes this morning to join us. As we jump into our call, Nate, if you'll advance to the next slide. Just a quick, here are our speakers for our time today. Again, we'll be joined by Nathan Willis and Peter Klingelhofer. They both are senior portfolio managers on our team here at OneAscent, and will be bringing some wisdom to us throughout the call. If you'll go back real quick, if you have questions, you can send those to us in a couple ways. You can email them to us, info@oneascent.com, and hopefully we'll have some time for Q&A. We'll answer many of those on the call. If we can't get to them on the call, we'll follow up via email. You also can use the chat feature here built into Zoom. So we'd love to get to some questions that you may have at the end of our time together. So Nate, if you'll advance. And so obviously this is a timely call. The last few weeks have been pretty volatile in the markets, and it's turned into a down market is what we would call it. And I want to, as we start our time, before we get to some of the details, I wanted to just acknowledge this fact. The down markets are challenging. By no means is this an easy time to be watching your portfolio, but down markets offer some opportunities. And so I want to share a few practical ideas before we get into kind of the nuts and bolts of what's going on in the market. So if you are accumulating assets, if you are in the phase of you're still saving and building up, still actively working, here are a couple practical things you can think about. One would be consider larger than normal 529 contributions. With what we've seen in the markets, prices are down, therefore prices are low. So this could be a strategic way to invest in future education costs at a discount, whether that be for your children or grandchildren. Another practical potential thing to consider with your advisor is a Roth IRA conversion. If you convert a traditional IRA assets into a Roth, again, while values are down, that can reduce the tax impact and set you up for tax-free growth and withdrawals in the future. So things you can be doing. Lastly, continue consistent contributions and even increase them if possible. Right now, prices are down, and so no different than any other things that we shop for or buy as consumers. When we invest in stocks, the price that we pay is our entry point, and we hope for that to appreciate. Buying during downturns can lead to stronger long-term results if you have the ability to maintain or even increase those contributions. So that's if you're accumulating assets. If you're taking withdrawals, maybe you're in retirement or you're using your investment accounts to fund day-to-day lifestyle expenses, make sure you stick to that personalized withdrawal strategy. The way that your portfolio was built, if you're working with an advisor, it was designed to weather market fluctuations because it's diversified, because of the long-term focus. Make sure to stick to that and not make untimely decisions. Second would be to review that withdrawal rate. Make sure it's still appropriate in the current environment. Do that with your financial advisor to make sure that your plan is still intact and on pace. And then lastly, consider drawing from cash reserves or lower risk investments. If you do need to generate cash to take withdrawals, do that from places that are already in cash or lower risk investments. That'll reduce the need to sell long-term investments at a loss, more like equities and stocks. So think about where you're taking those distributions from. So those are a few practical things if you're accumulating or taking withdrawals. Something for everybody, and something that we focus on a lot here at OneAscent is now is a good opportunity to focus on what you own. And we call that values-based investing, where we focus on what types of companies we own. Values-based investing is simply deploying our financial resources in a manner that aligns with our values or convictions to accomplish a financial return. So this is a good opportunity to take a look at our portfolios and see if it aligns with our values. Do we believe in the companies that we own? Are they creating blessing and value for people through the products and services that they offer to the marketplace? And so a few more quick layers of what we mean by that. At OneAscent, the way we approach values-based investing, it's a three-step process. Number one is eliminate. There are certain companies whose products or practices we believe cause harm. They actually extract value from either their customers or maybe even society at large, perhaps the employees. So we eliminate those companies from our universe. Step two is we're still investing. So we evaluate to make sure companies meet our investment objectives. They've got to be great investments. And finally, we want to elevate those companies that are actually bringing blessing, that are making the world a better place. So the companies that we own in our portfolios, we've taken the first step of eliminating those that cause harm. We're identifying good investments, but also great businesses. And we do all of this through a platform that we've built here at OneAscent called Elevate. This is our system that we've developed in-house that allows us to do this with excellence and with rigor. You see some screenshots here, lots of data that flows into this system so that we can help you align your values with your investments. At the end of the day, we want to be your partner for values alignment. And we do that through the different solutions that we offer. Today, we're going to be talking about our multi-asset solutions and a general kind of outlook on the market, but we do that in public and private. We do that through tools like our Align tool and our Elevate tools that you can access through your financial advisor. And then finally, through our insights. We put out all kinds of content and commentary and things, this webinar being one of them, that we would love to keep you informed of what's going on in the markets, but also what's going on in your portfolio and what you own and why you can be proud to own it. So with that, I'm excited to turn our call over today. I believe first to Nathan. Nathan, are you going to go first?
I think Pete will start things off.
Okay, sorry for that. So we'll get started with Pete to give us just a recap of the first quarter, and then we'll get into our outlook for the markets. So Pete, take it away.
Good morning, everyone. Thanks, Cole, for that introduction. Excited to present our review of the first quarter. But more than that, we really want to dig into our navigator process and our outlook, and then sort of finish up with what actions you should be thinking about taking in portfolios today, given what's happened and what we're looking forward to over the next 6 to 9 months. As we turn to the next slide here, you can see that returns from last year, or from the first quarter, were a bit different than they were in the fourth quarter of last year. That was a big change, right? We saw a big reversal in what did well and what did not do well. All capitalization segments of the U.S. stock market underperformed, right? They were all down. International equities had a pretty good first quarter, and that's a big change as well from what we saw in the fourth quarter and most of last year. International struggled last year, and we know there's been some positive changes there that have helped. And interest rates in the first quarter were weaker, right? They fell from almost 4.6% to roughly 4.3% around the end of the quarter. So bonds posted better returns for Q1. So one of the points here is that diversification was really helpful, right? If you think about last year, and we'll turn to the next slide and get into more detail on the trailing 1-year results, but that last bullet point, the Mag 7 on the previous page, is really different when you look at 1-year returns, right? Because we know that the trailing 12 months, about 3 months ago, Mag 7 was up over 50%, right? And that's a big difference at this point after 1 quarter of poor returns from the Mag 7. But even so, on that trailing 12-month basis, that Mag 7 number stands out relative to everything else. But if you look at the other asset classes, S&P 500 and emerging markets, they delivered in line with long-term return expectations. So mid and small caps did lag, And that was a bit unfortunate, but they're a little bit more attractive now, and we like them for the long run at this point. Bonds delivered returns that were very consistent with the yields, right? That was very positive, actually, in terms of that diversification benefit on a trailing 12 months basis. And international equities, much more in line with domestic outside of that Mag 7. So the world is starting to adjust from a very narrow market in 2023 and 2024 to one that is broader and more diversified. And if we turn to sector returns on the next page, you can see that broad and diverse performance with a little bit of reversion was really on display in Q1, right? Energy and healthcare were leading sectors, right? They were lagging sectors last year. Well, starting this year, they've been at the lead. And if you look over on the right of that graph, you'll see that communications, tech, consumer discretionary, they were down significantly on the quarter, right? And now if you look at their trailing 1-year returns, they don't stand out. In fact, it's pretty interesting that utilities and financials are the ones that stand out on the trailing 1-year basis. So the world has changed quite a bit in terms of what it favors. Value sectors showed major improvement and growth reverted. So it's a bit of a different backdrop as we move our way through 2025, one that's very helpful to us because we're positioned more for diversification and more broadly. And I think that's going to wrap my comments up for the moment. I'm going to turn this over to Nathan, who's going to get into more of the Navigator outlook, and he should have that now.
Yeah, thanks, Pete. Yeah, so I think one of the big themes of the first quarter is significant change in leadership of the markets. And one of the themes of this call and one of the themes of our overall outlook is uncertainty. So how do we process uncertainty? How do we think about our portfolios when things are very, very uncertain? Well, we have a really good process for that, and it's the Navigator. And so we have, 4 areas that we focus on. And so we focus on valuations in the economy, so the kind of fundamentals. And then we focus on technicals. What are prices telling us? What's happening in the market? And then we look at sentiment. So what are investors primarily, but also CEOs, consumers, Fed speakers, what is their sentiment? And we process all of that. And so we're going to do that now. We're going to do that in a slightly compressed format versus most of our calls, because we're going to spend a lot more time on what's changed since the end of the quarter. It's been a pretty interesting first 15 days of April. So let's dig into the setup before we talk about the outlook. So recent data points to accelerating inflation, okay? And so one interesting thing to note, in April, inflation data, the actual data for March, came in a little bit below expectations, even though we saw some potential for acceleration here. However, the survey data, so people's fears, people's worry about inflation has skyrocketed, okay? And that is because of the Trump tariff issues, and we'll talk about that more. So then we talk about a bear market, and we kind of briefly dipped into one. And so how do we think about a bear market? How do we think about processing potential bottom and moving forward? And so what we would say is market breadth, in a couple different ways we're going to look at here, is not really giving us a strong signal that we're at the bottom yet. So if you look at this chart with me, the advanced decline line on the bottom, and this just literally shows the number of New York Stock Exchange stocks that are going up divided by the number or minus the number that are going down every day. And it's just cumulative. And so when the market recovers, but this advanced decline line doesn't really recover, that was a really sharp recovery that doesn't feel like it has a lot of legs to it. Another way we look at this is the percent of stocks trading above their moving averages. So you can see here at the top of this chart, the S&P 500 has dipped below its 200-day moving average. We also look at the percent of stocks that are above or below the 200-day moving average. And if you look at this, the percent of S&P 500 stocks that are above their 200-day moving average is 29%. And the percent above their 50-day moving average, a little bit of a shorter signal, is 20%. So if you look at the COVID bottom, both of these measured bottomed out in single digits, like 4 or 5% of stocks were actually trading above their 200-day moving average. And so we're not at a bottoming process yet. We're in the process, but we don't think we've necessarily hit the bottom if indeed we're actually going to have a sustainable bear market. I think there's still some ambiguity there, and we'll talk more about that. But one of our anchors is valuations. And I'm going to turn it back to Pete to talk about valuations and go through a couple more steps of our process.
Great, thanks. So on this valuation chart, what we're showing here is a forward PE, and we're looking at the last 30 years. And that's important because that's really from the mid-90s. And this is the time frame of the modern market, right? This is the information technology age time frame. And you can see the PE's been all over the map, right? It's been as low as basically 10, and it's been up in the 25 range, and this is on a forward basis. But what are we looking at now? We're looking at a multiple that's dropped from 22 to 19.5 on a forward basis. And that's not really enough of a drop. As you can see, that dotted line in there is showing the long-term average of 17 over this 30-year time frame. And you can see that over the last decade, when we've had sell-offs, some of those sell-offs, the PE contraction wasn't as large as it was this time, right? If you look at 2015, the sell-off wasn't as significant, but the bottom level for the PE at that point was in the 15 range, right? And if you look at each of these instances, and some of these you'll know, March of 2020 was obviously COVID. And you can see COVID, the forward PE only got down to right around 17. So as dramatic as COVID felt, the PE on a forward basis didn't even fall below what it did in 2015 when we had what I would call an industrial production recession. You might recall the oil price went down to like $28 then. And then recently, during the big sell-off in 2022, you can see the PE multiple bottomed in that 15.5 range then. And if you go back to the 10% sell-off we had in late 23, you'll see that bottom was like in the 17 to 17.5 range. So the point of this chart is to just show that valuations really haven't retracted enough to give us the margin of safety we'd really like to see. And when you put that together with some of those other factors Nathan was just discussing, it's not like you really want to add risk in a significant way. And if we go to the next slide, you'll see how we address the navigator on a color scheme basis. And this has changed a little bit. Last quarter, we had the economy with a green tone to it, and we had sentiment with a yellow neutral coloration. So this has changed a little. Sentiment has gotten so negative that on most measures, and Nathan will share some of this later, on most measures, those sentiment factors would tell you historically it's consistent with a buy zone. But we've still got valuation at red, which I've just discussed, and it's not quite gotten to a level where that margin of safety is good enough. So I'm going to focus a couple of comments here on the valuation and earnings. The economic point is things are slowing, right? We are seeing impact from uncertainty around tariffs. Consumers are a bit confused, right? So there's definitely some slowing on the spending front, but it's not just consumers. If you're a CFO at a major corporation, you're probably putting some CapEx on hold. Here in Ohio, where I live, we've seen many announcements, including a big data center announcement by Microsoft that they've pushed back and paused. So CFOs are definitely holding back. So that's a big part of the reason the economic one is now yellow. And I'm going to talk now on the next slide about what we think that means for earnings. And what you'll see here as you look at earnings going forward, these are three scenarios. There's a myriad of scenarios that could potentially hit earnings, right? positive or negative. But what we're starting with is this $270 view, which would really be that if we see a pivot from the Trump administration and we avoid a recession of any meaningful amount, and we get back to kind of the trend we were on, and you could actually see earnings up in this 270 range over the next 12 to 18 months. Current estimates for 2027 are pushing $300, and we've thought that that was way too high since the beginning of this year. So our best case scenario is this $270 range. Our base case is more that earnings would kind of flatline. They would be in this 240 to 250 range, maybe up as much as 2 or 3%. And that would be consistent with slow to no growth, and a mild recession, perhaps even. Revenues would be okay because pricing, given tariffs, there's going to be some price increases, right? We know there's going to be positive inflation, maybe more than we want. And with that, we expect weaker profits, right? So profit margins maybe not as good. Revenue's okay, weaker profits, earnings flattish. But the risk in the scenario is this $200 level, and that's if we go into a recession that could be meaningful, partially due to tariffs, partially due to inflation risks, and really people pulling back on spending in a meaningful way. Well, that would mean much weaker employment levels. And this $200 level, it's possible, right? I mean, you look back at this chart, you can see that earnings took a big hit in COVID. And the reason earnings reaccelerated after COVID is because the government stepped up with massive stimulus. Keep in mind, we didn't have as much debt back then, so the government had a lot more flexibility than they do now. And one of the important points to make on this chart is markets are discounting mechanisms, and the market will discount. If we go into recession, the market will discount 200 in earnings very quickly, just like it did in COVID, right? The COVID sell-off was because people thought earnings were going to drop all the way to $100 or maybe even 120. They didn't actually, because the government saved it. But in this case, if we get to the point where we start discounting 200, very quickly, people will start discounting a recovery like they did in COVID. So you could have a situation where for a short period of time, the market trades at 20 times 200, which could be 4,000, which would be a meaningful downdraft from here. But in a 1 month period, like it did in COVID, you could shoot back up to 25 times earnings as people anticipate better earnings going forward. And that would bring you to 5,000, which is basically where we were in the last week. So people who are arguing we've already hit a bottom, it's possible, right? If Trump pivots, it's possible. But we're not getting enough margin of safety to really bump up the risk yet. And Nathan's going to tell you more on the technicals and sentiment factors about what we're looking at in that regard.
Yeah, and before I do that, even I'm going to key off of one comment you made. I think about COVID. You said it was bad until the government saved it. Okay, so this next slide is my Ronald Reagan slide. So one of his most famous quotes this was in 1986. Reagan said the 9 most terrifying words in the English language are "I'm from the government and I'm here to help." Well, this illustrates Trump's version of that. Okay, so this chart normally had a strong relationship between Treasury yields, which are in gold, and the dollar index, which is in blue. And so what this means is that when Treasury yields go higher, people want to buy our bonds, and so foreign purchasers buy them, and that means they have to buy dollars to buy them, and so the dollar goes up. When yields come down, the dollar goes down. Well, when Trump kicked off this tariff tantrum, or however we want to call it, this relationship broke, right? So the 10-year Treasury yield shot up because inflation expectations also shot up, but the dollar dropped because people were worried about what would happen. Is the dollar supremacy going to kind of lessen, or just kind of all sorts of what chaotic things might happen because of this. And so this is really the one thing that I wanted to illustrate that the bond market has been quite chaotic. We wrote about in our weekly just yesterday that the kind of one of the reasons for this volatility was something called the basis trade. I won't go into that because it's a bit wonky, but it involved a ton of leverage. And so anytime leverage unwinds, things go a little bit crazy in the markets. And that happened here in Treasury bonds. You would normally see Treasury bond yields dropping when stocks sell off because you get a safe haven bid. Normally, the US dollar would go up when US stocks sell off because of a safe haven bid, because the dollar is perceived to be the strongest currency. So uncertainty has led to volatility. Now, what else can uncertainty do? It can set up very, very sharp rallies. And it can set up sharp rallies specifically when the government steps in. Like Pete said, the government saved it. So let's look at that. This chart shows the top 20 single-day returns since, I think, the 80s. And you can see the gray one, third from the left, was last Wednesday, April 9th, okay? And it was up 9.5%. And so let's talk about what these sharp rallies look like and what were the conditions that allowed those, and then what that might say about the current market and whether we form a new bull market in stocks. Okay, there's a lot we're going to unpack here. But first, let's just look at them. So first of all, we had a couple really strong moves during the technology bubble of 2000 to 2002. We had a bunch during the global financial crisis of 2008 and 2009. And then we had a few during COVID-19. Okay, so what I want to point out is two of these three episodes have an ingredient that we think is important going forward, which is a lot of time. So the technology bubble lasted really for 2.5 years or so. The global financial crisis really started in October of 2007 and went through March of 2009. So it was, a year and a half, really. COVID-19 was much shorter because it was a much, much stronger policy response. But the government stepped in on all of these stars to create a really strong one-day rally. It was either something the government did or something that the market thought the government would do, or some sort of response to some sort of government support, okay? So let's look at these and let's just put the actual day returns. And then what I want to do is to unpack what happens going forward. So we've got the next month, the next 3 months, and the next year. And if you look at these averages, all of them are well above, apologies. All of the averages are well above what we normally see. So the 32% following 12 months is what's most important. So when the government steps in, when there's a really, really bad bear market and there's a lot of volatility, this oftentimes leads to a really, really strong forward return. So the question is, do we have a setup for that kind of a return from today going forward? So let's look at a couple of other things to think about that. First of all, one of the things you want to see is very, very bearish investors. And that means there's no one else left to sell, okay? And so when investors are very bearish, retail investors in particular, the gold line on the bottom is the American Association of Individual Investors, the percent that are bearish. This is a weekly survey, and last week it hit 62. It dropped back to just below 60, but the only other time it was higher was in the depth of the crisis of 2008. So let's look at some of these episodes of investor bearishness to see how that might speak to forward returns. So the current episode has been very, very short, okay? Prior episodes, the 2008 crisis was a very, very long period of high investor negativity, of high bearishness, as was the tech bubble, as was the 2022 downturn. COVID was a fairly short-lived one, so I didn't really include that on here. But when we think about setting a stage for a new bull market, it's actually really important, or it's really positive, for there to be a longer period of investor negativity. That means there's kind of washed out negative sentiment, and when people finally start buying, there's a little bit of more kind of what people think of as money on the sidelines, wanting to go into stocks. So we've looked at daily returns inside bear markets, and we've looked at investor bearishness. Let's kind of look at bull market rallies or bull rallies inside of bear markets. Okay, so this, rather than looking at 1-day rallies, this looks at 1-month rallies. And so let's kind of look at this to see some evidence for going forward. So first of all, we had a few really strong months during the technology bubble. We had a few really strong months during the global financial crisis. Okay. And so what I want to do now is talk about the conditions for a strong recovery from here. And we've talked a lot about these so far. So first of all, you want attractive valuations. And right now, we would say this is kind of yellow. Valuations are red in our kind of viewpoint, but they're beginning to get better. And so we're kind of, that's a warning signal, but we're kind of thinking about them as yellow, not super red. We do want extremely oversold markets. We want kind of panic. That's kind of technical and sentiment. We feel like we've got that. We want monetary or fiscal actions, back to Pete's comment of the government saved it. All of these stars on the left correspond to times when the government stepped in with something, and we have not seen that yet. Trump could, flip-flop very, very quickly and move things forward. Last thing we want is expectations that earning will improve, and I think Pete pointed out that we're not necessarily seeing that. So what are we anchoring to in this kind of environment? When there's a lot of uncertainty, you've got to go back to what's most important to you. And so we look at our Navigator outlook, and what is most important to us for long-term returns is valuation. So let's talk a little bit about how valuations have changed during this little sell-off that we're experiencing this couple months since the middle of February. So this is a really good chart from Goldman Sachs, which shows the forward PE relative to the 20-year distribution of PEs, okay? So each of the little rectangles is the 25th to 75th percentile, so it's kind of like the middle half. And then the way above and way below are kind of the tail distributions. And so you can see right now the NASDAQ 100 is in kind of an upside tail, right? The valuation is much higher than it's been generally over the last 20 years, although it's gotten less overpriced. Small cap stocks in the Russell 2000 are below average, not tremendously so, but a little bit below average. You can see the S&P 500, driven by technology, is actually more overvalued than the NASDAQ, which is interesting. I don't know that there's necessarily any information from that, except that maybe the S&P is a more often indexed benchmark with passive investors. But then when we start to think about things that are attractive, let's look at these last two columns to the right. So the equal weight S&P, so instead of taking the market cap weighting and having a ton of Amazon and Apple and Microsoft, if we look at every S&P 500 stock with the equal weighting, that's at a 15 times PE, right at its 20-year average. That's actually pretty good. But then what maybe begins to be compelling is mid-cap stocks, which are trading well below their 20-year average. And in fact, kind of near an extreme level. It's the only asset class on this chart that looks like it may be at a bit of an extreme level. So what I wanted to do was to kind of wrap up the conversation about uncertainty with going back to what is most important about investments. Our investment philosophy has 3 tenets. One of the most important tenets right now is that we are long-term investors, and valuation is the single most important factor in determining long-term returns. And so right now, Pete will talk about it, but mid-caps are probably our largest overweight in our portfolios relative to our benchmarks. So why don't I let Pete take over and kind of anchor again to the long term, and then we'll talk about our positioning.
So great job, Nathan. Thanks for bringing that home. This is, when Nathan talks about anchoring, this is really the key to multi-asset investing over a long time horizon, right? Valuations don't mean a whole lot on a 6-month or 1 to 2 year basis. If you think about what the Mag 7 did the last couple of years, the fact that they were expensive it didn't matter. They continued to go up as their fundamentals did well. But when you start looking at 10-year forward returns, the starting point, the price you pay at the beginning, is very informative of what your long-term returns are going to look like. We showed this at the end of the year. This was part of our CMA work that we do, capital markets assumptions. And that box that shows up in the 24 to 25 range is where we were on a trailing PE basis. When you're looking at long-term returns, it's important to look at trailing PEs because a forward PE is incorporating growth, and you don't want to do that. You want to anchor in what you know has happened, because what could happen in the next 6 months to earnings could be significant, right? So we want to anchor on what we know is already in the past when we do long-term forecasting. And the reality is we're still trading at 22 times trailing. And if you look at this chart, there are a couple data points you can see that show that there have been reasonably good long-term returns if you bought at this level. But the consistent line shows that you're going to get 3 to 4 to 5% even here, right? If you get down towards 18, you start really tipping the scales in favor of taking on a lot more risk, right? And that would be what we'd like to see. If we can get a couple more multiple points coming our direction, then we could really start thinking about getting high single digit, maybe low double digit longer term returns. And if you look over in the box on the right and you look at our 2025 assumptions, those numbers would be going higher right now, right? They're going to look more like the 2024 numbers at this point, given the pullback. So we're getting into a better range, but keep in mind that the 10-year yield at around 4.5% is, that's competitive with the returns here. So you're not getting paid a lot for the risk. So we'll move on to the next slide here to kind of talk about our positioning. And we haven't changed this a lot. You could argue that the short-term fundamentals and the way we run the navigator, that maybe mid and small don't deserve a positive. But when we anchor on that longer-term leaning towards valuation, what Nathan just shared with you about the mid-cap multiples, it's just too low, right? I mean, we're looking at this outside of the next 6 to 12 months, really. And mid-cap is where we think there's great longer-term opportunity. So when we talk about valuation still being red, it's primarily because a handful of stocks have really high multiples and they're keeping the S&P looking expensive. There are places for us to go. We like the international market. We are positioned to be overweight there. We are overweight mid and small cap, mostly in the mid-cap range. We're neutral large cap U.S. equities because those valuation premiums don't look justified to us. And we see some earnings risk there as well. And in emerging markets, we're neutral given a lot of the economic noise and the tariff noise. But emerging markets are cheap relative to history as well. So, and on the fixed income side, with yields offering pretty healthy returns from here, we're still remaining positive in a lot of these categories, not so much in corporates, given the risk and the fact that spreads could widen further. And then just tidy this up in how our funds are positioned on the next slide before I hand it off to Cole. Here you can see our entire suite of multi-asset funds, effectively how our models are positioned. But what we really focus on in this call is the moderate allocation. And this is where you can see where we might be a little bit different than others. That SMID cap allocation is very healthy relative to how most people think about multi-asset allocations. And you can see our large cap down at 23%. For a lot of people, they might make large cap 50 or 60% of their allocation. Well, if it was 50 or 60%, it would be up in the 30s, right? So that's an important point. We believe that over the next several years, SMID cap is going to outperform large. And the thing is, when that happens, it could happen in one quarter, right? You could just kind of like Developed Markets International did this last quarter. And that's an important reminder that these things happen quickly when they happen. And, last quarter, what we saw was Developed Markets International up around 5% almost, and U.S. large cap down about almost 5%. So that's a 1,000 basis point differential. And if you're not overweight when it happens, you won't capture it. So I'm going to finish my thoughts here and pass it back to Cole, who's going to finish up and maybe ask a question or two.
Great. Thanks, Pete. And thanks, Nate, for sharing your wisdom and expertise with us this morning. We got a time for a few questions. Again, you can email those to us, info@oneascent.com, or use the chat feature. We have a couple kind of coming in. And Pete, I know you're gonna need to run here in a second. So we'll let you got another speaking engagement to get to. Nate, I'll pose this question to you. Uncertainty is one of the big themes. I think we've talked about that today. It's what's in the news of what is Trump going to do? What are other countries going to do? What is China going to do? How are we navigating, portfolios? What are we doing actually in portfolios in light of uncertainty? Can you speak to that?
Yeah, I think one of the important things to note is that we don't have a clue what Trump or China will do, and really nobody does, and that's why we have this uncertainty. And I think it's important to remember that we have the potential for these incredibly strong one-day rallies. And so importantly, you don't go to cash, okay? Because that's just going to cause you to miss out on one of these strong returns, and that's going to cause you to make a poor emotional decision. We see that time and time again. So what you do need to do is you need to stick with your process, okay? And our process is our navigator process. And so our navigator process is how we implement our investment philosophy. So our investment philosophy is where we come home to always, and that's what you need to do as an investor. We are values aligned. We're faith-based investors, number one. Number two, we are long-term investors. And number three, we're globally diversified. And so being globally diversified has really helped you in this environment, and it's going to help you when you have a lot of uncertainty in the outlook.
That's great, Nate. Thank you. I was gonna call out the diversification piece. Can you go back? We hit it at the very top of our call, reviewing Q1 performance, just so everybody can see real quickly again. What's making headlines for us as U.S. investors is the S&P 500 and the sell-off. But interestingly, in international markets, those markets were up in Q1 and have been. So that's been something we've been talking about for a long time. The importance of diversification the last couple of years. It hasn't added to the portfolio, but in times like this is when it comes, like you said, comes home to roost. So, Nate, we have time for one more question. We want to try to keep our calls to 45 minutes. In terms of the bigger risk, is it recession or is it inflation? Those two things seem to be getting a lot of headlines right now. What are the risks that we're most concerned about?
Yeah, it's a loaded question. And I think one of the things you need to think about is the structural issues. And we wrote about it last fall. We wrote about the US government debt. Coming into this year, our capital market assumptions process led us to believe that there's a risk for higher inflation, even before anything happened with Trump's tariffs. And so I have to believe that inflation is a bigger risk because the US government cannot stop spending. Regardless of whatever program Elon Musk is running, we are addicted to spending as a government and as an economy. And that debt, that excessive debt, is going to cause problems. And that excessive amount of money is likely to cause problems. It's far easier to fix a recession, and that is another way to kind of process that kind of risk. It's far harder to fix inflation, to fix excessive debt. It's far easier to fix a recession. So I'm a lot more worried about inflation than I am about a recession.
Good deal. And I think it's worth pointing out just the timing nature. People tend to think this is our jobs, but a recession, the market reacts ahead of time, right? The way the timing kind of works out with recessions, that's already been priced in, and the recession will come after the fact, but the market's recovering by that time, typically. So, well, good deal. Well, for our audience, thank you all again for spending some time with us this morning. We greatly appreciate and value your time. I want to thank Nate and Pete again for their expertise. If you would like more information, we'll be sending out a replay of this call. As both of these guys have mentioned, we write a lot of information. We put out a weekly commentary. We'd love to have you follow us there if you'd like. But thank you for your time. Hope everybody has a happy Easter, and God bless. Be with you for the rest of the day. Thanks so much. Bye-bye.